Hey, Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to thank you, welcome you to another one of these quick informal videos about trying to answer all your questions about what's going on with the market and see if we can take advantage of these lower prices. Believe it or not, as stressful as this is, most of your market gains over that long-term period are going to be made right now. You're the decisions you make buying stocks at these points and being able to ride all the way up to the market rebound. That's where the majority of your gains are going to be. So I want to help you to do that. And today we got a great video for you. It's going to talk about the 5 dividend stocks on my buy list. Okay, I'm going to show you what I'm looking for in stocks, finding the companies that are going to survive no matter what the economy brings, and then I'm going to give you those 5 dividend picks that I'm looking at. Now, to be clear, I don't think the worst is over here, okay? We had over 13,000 cases reported in the U.S. alone yesterday. The U.S. will pass China and Italy as the most affected country by the end of the week, okay? That's my prediction, that the U.S. is going to pass Italy and China as the number one hotspot in the world by the end of the week. And we're just starting to see this come through in the economic effect with this morning's historically bad unemployment numbers. So what this is, though, this is my wish list, okay? The stocks that I'm watching that I can start to add exposure to even if the market bottom is in, okay? Like we've talked about over the last couple of weeks, you do not need to call a bottom in this market. Don't feel like you need to be watching the market every single day and jump in right as the market is bottoming, okay? I want you to make a strategy of, when you're going to invest your money, when you're going to invest certain amounts. So say you've got $100 of cash sitting around, you're waiting to invest in stocks, okay? Maybe invest 30% of it now, $30 of it now. Maybe make a plan for, okay, if the market goes down another 10%, I'm going to put that another $30 or $40 of that to work. Conversely, if the market goes up another 10% and you think, okay, maybe the market really has hit its bottom and it's going up further, then I'm going to put more of that money in and wait until I'm, fully exposed there. But you need a strategy of how much you're going to invest and when, so you don't stress out every day watching the market, worrying if you're going to jump in right at the right time, because you don't need to, okay? As we saw with the last bull market, or the last bull market from the bear, you could have invested weeks or months after the market had already bottomed in March 2009, still made excellent gains, excellent gains off that rebound, and 10 years of gains after that. So don't feel like you need to call the bottom on this. And that's exactly what I'm doing, right? These are the companies I know will survive. They're going to pay me cash dividends while I wait. I can start legging into my investment, so I can start putting cash into the investments. I can hold some cash back, so in case the market does get worse, then I can get in at even lower prices. But I know these are the companies that will eventually rebound with the market. So that's what we're going to talk about today. Again, I want to invite you to our private Facebook group, Let's Talk Money Together. That's there on Facebook. I'll leave a link to that in the video description below, or just go to Facebook and search for Let's Talk Money Together. Great group, over 2,000 people added, over 1,500 just in the last month alone, and we've got some great conversations going on the stock market, investing, and making more money. But I want to get to it because this is going to be a great video. I really love talking about this. And for everyone there in the nation, I'm not just going to drop 5 stock picks in your lap, okay? That does absolutely nothing for you. I want to give you the tools. I want to show you what I'm looking for in companies, in the stocks I pick, so you can pick better stocks yourself. So we're going to start off here, and anytime the economy gets bad like this, you want to look for survivability. You want to look for companies that are not only going to be able to survive, but are going to be able to thrive and take market share from weaker rivals throughout this. So the first thing we're going to look at is the balance sheet, okay? Now, the balance sheet is one of 3 financial statements that a company reports every quarter and every year, okay? Now, the balance sheet it shows you all the company's assets, its liabilities, so all the assets, everything it owns, like property, plant, equipment, cash, its liabilities, everything it owes. You've got your payables, everything that it owes its employees, everything that it owes as far as creditors, and then the equity. The equity is what's left, and that's what's owned by shareholders, okay? And this is just a great picture of how stable that company is, what its debt situation is and leverage, and what investors actually own. while the market is looking better over the last few days, I still think we have a lot of economic pain to go, and I want survivable companies. Okay, so we're going to first look on the balance sheet here, and basically we're going to be looking at, how much cash they have on the balance sheet, their debt, the debt levels and their credit rating and things like that. So we're going to use Apple as an example here, and we can go to the balance sheet and see that they have cash and short-term investments of $107 billion here. Now the cash on the balance sheet is always going to be that top section, okay? It's going to show you cash. It's going to show you some short-term investments that they have that aren't necessarily cash, but it's pretty close. They can convert them. They're very safe investments normally. So $107 billion in cash. And then we're going to play back and forth here. We're going to go to the income statement here as well. Now the income statement is more of that profit and loss statement. Okay, this is one of the other financial reports that a company shows every quarter and every year, and it starts with the revenue, right? It starts with this total revenue or sales number, and goes all the way down. Takes out what they pay their suppliers, what they pay to run the company, and those operating expenses. It takes out all the money they pay for interest on their debt and everything, taxes, everything here, until they get to their earnings, and that's earnings per share. Of course, the bottom line is what a lot of investors look for. But there are a lot of things on the income statement that you really want to watch for, things that are actually much more important than that bottom line earnings number. So what we're going to look at here is then the amount of interest that the company pays every quarter or every year. Okay, very important here when we're talking about companies that in an economic recession where sales are going down and companies might not be collecting nearly as much as they had in the past. Can they still make those debt payments? And even the operating expenses here as well. Okay, so we'll work down here from the income statement, and we're still using this Apple example, and we'll come down to where it says interest, right? Interest payments, and it looks like Apple is paying about $35 billion or $3.5 billion a year in interest payments, okay? So not too bad there. But then we also want to look at this operating expenses, okay? These a little bit higher up, these operating expenses. This is what the company pays to run the business, okay? So it's going to be things like staff, marketing. It's usually lumped into this selling, general, and administrative, right? And so for all of these operating expenses, we see Apple spends $35 billion a year in these. Okay, so now what I'm thinking is if we go back to that balance sheet number, $107 billion in cash. Now, if you have the $35 billion in operating expenses, so what it takes to run the company each year, the $3.5 billion in interest expense, the amount that it takes them to pay the interest on that debt, it's about $38 billion, right? Well, if they have $107 billion in cash, that is potentially a very long runway, right? Apple could collect zero in sales and still be able to pay those operating expenses and the interest for the next year or two, or 3 years, in fact. So excellent balance sheet here, and this is really what I'm looking for when I look at the balance sheet and survivability for companies, okay? Now, the last factor that I want to look at before I go to this 5 dividend stocks that I'm watching is going to be profitability. And we're going to go back to the income statement here. And there's really 2 measures that I want to look at, the gross margin and the operating margin. Okay. And these are just 2 measures of profitability, and I'll explain each of them now. And when you look at these, you're going to want to look at them relative to other companies in their industry. Okay. So you would compare, Apple against other consumer electronic products. Companies. You would compare Ford against GM. You wouldn't compare Ford against the banks, like Bank of America, because they're going to have very different profitability margins. It's just a different business model, and they're run differently. But what you want to do, you want to go into the income statement here. So the income statement is going to start off with sales. It's going to start off with either sales, or it says total revenue here. And then below that is what the company is paying its suppliers, right? All its hard components that it goes into the products. And then just below that is going to be the difference. It's going to be the sales minus that cost of goods, okay? And it's going to say gross, like gross income or gross profit, right? And what you do is you take that gross profit out of sales for a percentage margin, okay? That's your gross profitability. And if we look here in the Apple income statement, we can see Apple had a revenue of $267 billion over the year, and then a gross profit of $101 billion. Okay, so after paying suppliers, it had $101 billion left over of that 267. And if we divide that, 101 divided by 267, we see it has a 38% gross profit. So now this just gives us an idea of costs, an idea of how well Apple is able to leverage its size and its strength to maybe get lower costs from its suppliers. And again, this is very important to compare against competitors in that same industry, because if Apple, obviously, in times of this economic hardship here, if Apple is able to push its suppliers a little bit harder and get those inputs for a little bit cheaper, then it's going to have more survivability than its peers, than its competitors. So it's going to be able to still create those earnings even when sales are down a little bit. Now, another one we want to look at here is called the operating margin. And everyone in the nation knows this is my favorite, bar none, my favorite measure, my favorite factor in picking stocks, okay? The operating margin, if you come down here further in the income statement, then you have what's called the operating costs, okay? These are going to be lumped, like I said earlier, into things like selling, general, and administration. They might be marketing costs, things like that. But it's just what the company is paying to run that business, what management is paying. And this is an excellent, excellent measure of management effectiveness, okay? You know, this shows you how well management is doing at, you know, keeping costs down for running that business and creating more profits, right? So it's how effective and how efficient management is at running the business. So if we look at our example here, Apple had an operating profit of $66 billion. Okay, so $66 billion in operating profit against that revenue of $267 billion for a 25% operating margin. Okay, so again, you're taking this operating profit number, this number of you know, the income left over after paying all those operating costs, after paying the suppliers, you're taking that number, divide by sales to see how well management is doing at converting those sales, that top line number, into this operating profitability. Okay, so you've got a 25% operating margin for Apple. And again, what you want to do, you want to compare that against its peers, against its competitors in that same industry to see, you know, if 25% profitability there is good or bad, or you know, what you can draw from that as far as Apple's strengths in its finances. So I'm going to take those factors, or a combination of those factors, the strong balance sheets, the brands, some companies that might actually even benefit from this lockdown, and I'm going to find some dividend stocks to put on my watch list. Okay, some of these are actually companies or funds that I actually already own, but I want to put them on my buy list to add more exposure, because I think they could really do well. They could provide the safety that I want through, you know, as bad as this is going to get, and then survive and thrive through that rebound. And our first stock here is Digital Realty, ticker DLR. And this is one we actually talked about in the Facebook group last week. I was really surprised when I looked at my portfolio, and this stock is actually up 3.4% for the year, which might not seem like much, except when the rest of the market is down, you know, 30% plus. And it's because Digital Realty is a real estate investment trust, so it owns commercial property and passes those rents on to investors. But it owns data centers, which are how the internet and companies connect through the servers housed in those data centers. Which obviously, you know, if you get everybody at home, telecommuting, working from home, streaming videos from home, then you're going to have more demand for these data centers, and companies like this Digital Realty could do very well. The company owns 260 data centers in 40 major cities all around the world, so it's very well diversified geographically, as well as it's got all the hubs in the U.S. there. As far as balance sheet, the company has $630 million in cash against about $210 million in annual operating expenses, and this is minus that depreciation. Okay, so if you look at REITs, so real estate investment trust, one very important thing you always want to look at is the depreciation on the income statement. You want to minus that out when you're looking at some of these cash flow numbers, because, you know, of course, since these companies own all that real estate, depreciation tends to be a very high number, and it skews their earnings lower. So it's not a very good measure of you know, those actual costs, those actual expenses that a company has to pay. So you always want to minus out depreciation whenever you're looking at a real estate investment trust. So about $210 million in annual operating expenses there, and $350 million in interest expenses each year. So that gives them at least probably about a 1 year runway at least to pay these interest expenses and operating expenses. So very financially stable, as well as they're not one of these companies that sales are dropping to zero, because they're very much open for business right now and actually doing very well. So a 3.8% dividend yield on this, so very good yield and excellent safety in this one. The next dividend stock I'm watching is actually a fund. It's the Spider Utilities Fund. That's ticker XLU. And I think this is a great opportunity right now because this holds shares of 28 companies in the utility sector, mostly electric and those multi-line companies. And it's down 23% this year on fear of that drop in business demand. Okay, so yeah, obviously any electric company is going to have a lot of demand drop from the business customers that aren't turning on their lights right now. But this is a hugely safe. These are hugely safe companies. Obviously, all the residential customers are going to be having, increasing their demand if they're home all day. But even on that demand decline from the business customers, that's going to jump right back up when people start going back to work. These are safe companies, a solid yield that's going to continue to attract cash flow investors. Next on our dividend list is ExxonMobil, ticker XOM. And I know I'm going to get a lot of pushback from people that they don't want to invest in the oil companies, but oil has been hit hard this year, not only from the demand destruction from the virus and from businesses shutting down, but from that little price war between Russia and Saudi Arabia. Saudi Arabia and OPEC wanted to decrease production, wanted to support higher oil prices. Russia wouldn't go along. So Saudi Arabia said, "Hey, that's fine with us. We'll just increase production and we'll wait everyone else out with these lower oil prices." So it's really hit the oil market. Oil's actually fell to below $20 a barrel. It's rebounded a little bit, $23, $24 for West Texas Intermediate, and what you've got is an excellent opportunity in some of these larger integrated oil companies. Okay, so we're talking about Exxon. We're going to talk about Chevron pretty soon here. These companies that, they're getting hit hard. The oil price of oil is below their cost of production, but they have the financial strength. They have the balance sheet to survive this. They're going to pick up market share from as maybe smaller competitors fall out. And they've got some great dividends. So the dividends here are the highest in the market. I actually want to look at a chart by Morningstar that shows break-even costs with the dividend for a lot of these major oil producers. And this is a really interesting chart. Really some great research there by Morningstar. And it does show that Exxon is a higher cost producer, right around $75 a barrel, to be able to cover that dividend as well as their costs. But it is coming down. They're actively working to bring down some of their costs. Exxon was one of the most aggressive spenders for investment spending over these last couple of years. While a lot of the other companies were pulling back on investment spending, Exxon has actually been spending more, and that's why a lot of its cost of production is a little bit higher. But it's got a great pipeline. Okay, once this thing blows over, and I actually think that we will see some kind of a cooperation between OPEC, Russia, and maybe even some of the U.S. drillers here pretty soon. That's going to support the prices and even push it higher. Once those prices do rebound, Exxon is going to be the one that benefits, because this pipeline of projects that it's got in the works here, it's going to start pumping, producing even more crude, and it's going to make even more money out of that. But of course, anytime the price of oil or the price of a company's product in general is so much below its production costs, you want to look at that balance sheet again, and you want to make sure the company has that survivability. So if we look at the balance sheet on Exxon, it's got $3.1 billion in cash, $24 billion in long-term debt against about $200 million in equity. So actually a very strong balance sheet, even though it's got quite a bit more debt there, $24 billion, but it's still only, so about an eighth of, debt to equity. So about 0.12, right? And actually, Morningstar does point this out as a strong balance sheet and the idea that debt can be raised to support that dividend short term. Okay, one of the cardinal rules for management is never cut the dividend. All right, if you cut your dividend, that is a crystal clear signal to investors that your company is in trouble. So of course, management tries to avoid it at all costs, and they'll issue debt to support that dividend in the short term if they can. And what they're saying here is that Exxon has more than enough capability to raise their debt a little bit and be able to pay that dividend. And in fact, the dividend yield is 11% and lots of financial survivability there. So I actually own shares of ExxonMobil, and I'm planning on buying more there. Our other big oil play here is Chevron. So ticker CVX. This is the lowest cost producer at about $50 a barrel. It's a major producer and has a great balance sheet. This is probably, even more than Exxon there. This is probably the best bet in those major oil companies right now. This is your best bet for safety. It's got a great dividend yield and an excellent balance sheet. And that lowest cost producer status is going to really help it survive through this downturn. If you look at the balance sheet there, $5.75 billion in cash. So quite a bit smaller than company than Exxon, but even more cash on the balance sheet. $24 billion in long-term debt against $145 billion in equity. So a little bit higher debt to equity because it does have that $24 billion in debt against about $150 in equity, but it's still a very good debt to equity position. And this is another one that can raise more debt. It can borrow more money to support that dividend in the short term if it wants to or if it needs to. A dividend yield here is 9.5%. So very rare that you can get almost a double-digit dividend yield in a company that is financially stable, financially strong, and you're going to be collecting that dividend for years and years. Our next dividend stock here is actually another fund, and again, members of the Bowtie Nation there will have heard me talk about this one often. I love the Alarian MLP fund. That's ticker AMLP. Now, this is a fund that holds shares of 22 master limited partnerships. These are companies that own pipelines, refineries, storage facilities in that oil and gas space. About 74% of these companies are own those pipelines. The rest is in storage, refinery, and then that natural gas liquefaction. This fund has been crushed over the last few years, though, right? As the price of oil came down in 2014 and really kind of stagnated right around there, $50, $60 a barrel. A lot of these pipeline companies just couldn't compete with some of the weaker prices. But like I said, I do think the Saudis and Russia are going to come to an agreement. It is relatively safer, this fund, because it is a fund. Okay, you've got shares in 22 master limited partnerships, 22 MLPs here, instead of trying to pick which MLPs are going to be able to survive this low oil price environment. This one has an 11.5% yield, though that might drop a little bit as some of these companies do seek to protect cash, so they'll lower their dividend a little bit over this next year to protect that cash flow. But I'm still expecting this one to be at least 7.5% yield or higher. That is a great dividend yield, and this one really has that potential to snap back and make up a lot of those returns when the price of oil does rebound. So that's going to be the 5 dividend stocks that I'm watching right now. I'm adding to my portfolio. I actually own a few of those, but I'm going to add more to my portfolios. These are strong, stable companies that are paying me to hold the investment and to wait it out until that price rebound. Again, stay safe, stay calm. Join the community there on Facebook. Look for Let's Talk Money Together on Facebook, or just click through to the link I'll leave in the video description below. Ask your questions below, because that's where I'm really getting a lot of these ideas for these informal videos. And I will see you in the next video.